In 2021, a steel Patek Philippe with a retail price around €60,000 saw a 50% price surge the week it was discontinued. Within months, it was trading above $100,000. One special edition hit $6.5 million at auction. This isn't a fluke. Behind every ultra-rare watch selling for many times its retail price, there's a hidden economic system most people never see. About 60% of the most desirable pieces are spoken for before a new customer ever walks through the door. The waitlist isn't a line, it's a filter. So who really profits from the gap between what a watch costs and what the market says it's worth? To understand how this happens, we have to look at how these watches are distributed. Most people think a high price comes from a simple formula: high demand and low production. If a factory only makes 10 watches, of course they will be expensive, but that is not how the modern luxury watch market actually works. These companies have the machinery, the staff, and the money to build far more watches than they currently ship. Rolex makes an estimated 1 million watches every single year. Yet, walk into any official retailer and the display cases are completely empty. Think about that for a second. A company makes 1 million products a year, but you cannot buy a single one. This happens because of a system called managed supply. The manufacturer does not sell directly to you. They sell to a middleman, the authorized dealer. These dealers act as gatekeepers for brands like Rolex and Patek Philippe. Instead of putting watches on shelves for the first person who walks in with cash, the dealer decides who gets to buy them. Insider reports show that dealers reserve about 60% of their new inventory before the public ever gets a look. The watches do not sit in display cases waiting for a random buyer. They are earmarked for a small group of VIPs, local business owners, and big spenders. This system turns classic economics on its head. In a normal market, if people want to buy your product, you make more of it to increase your profits. But in the luxury watch world, flooding the market ruins the magic. If everyone can get one, nobody wants one. The real value is not the metal or the movement. The value is the difficulty of getting the item in the first place. The authorized dealer network keeps this gate locked tight, ensuring that supply is always kept just below the level of burning desire. When a hopeful buyer walks into a store and hears the words "I can put you on the wait list," they usually picture a neat, orderly line. They think they are number 50, and when 49 people get their watches, their phone will finally ring. But that line is a structural fiction. In reality, the luxury watch waitlist functions as a screening system rather than a chronological queue. Authorized dealers act as gatekeepers, maintaining what they call an interest list. On this list, your success depends almost entirely on your relationship with the dealer, not on when you walked through the door. To get to the front of this invisible line, cash is not enough. The dealer evaluates your purchase history, your local social profile, and how you carry yourself during store visits. Some sales representatives treat every conversation like a job interview. If you want a highly coveted steel sports watch, you might have to buy $30,000 worth of slow-moving gold jewelry first to prove your loyalty. The dealer decides who is worthy, shaping the entire market before a single resale even begins. Let's look at the alternative. If you refuse to play this relationship game, there is a shadow market waiting. Grey market dealers operate as independent sellers who bypass the official boutique network entirely. They have the highly coveted watches in hand, ready to ship today. You can buy from them without going through interviews, waiting lists, or forced jewelry bundles. But skipping the gatekeeper comes with a massive financial penalty. The moment a watch escapes the authorized dealer's grip, its price tag mutates. A timepiece that officially retails for $8,000 can instantly command $18,000 on a grey market website. That $10,000 markup is the price of convenience. It is a premium paid to avoid the waitlist entirely. This first authorized sale is what creates the entire secondary market. The line exists to make the watch feel impossible to get, creating a highly profitable scarcity loop. When confronted with these secondary market markups, the watchmakers themselves offer a very different explanation. Rolex has stated publicly that scarcity is not their business strategy. In an official response to industry questions, the brand declared that their current production simply cannot meet the existing demand without compromising the quality of their watches. To maintain their high standards, they claim, they cannot simply ramp up the assembly lines. But there is a major contradiction in this defense. Rolex does not publish its exact production numbers. The company operates behind a wall of silence, leaving the public to rely on outside estimates. While experts believe the company makes about 1 million timepieces a year, no one outside the brand knows how many steel sports models actually leave the factory or where they are shipped. This opacity is where the real power lies. By keeping their numbers secret, the company can deny they are engineering scarcity while enjoying every single benefit of a shortage. The empty shelves do not hurt the brand, they build its myth. When a product is perpetually sold out, it stops being a simple commercial item. It becomes a Veblen good, a product where high prices and low availability actually make people want it more. This is how silence becomes a highly effective marketing engine. The less a brand says, the more the market speculates. A watch that is impossible to buy at retail generates constant free press, fueled by frustrated buyers and online forums. The system relies on this disconnect. What the brand calls a production limit, the market treats as an invitation. It turns a retail purchase into an active hunt, shifting the focus from the watch itself to the social status of the person wearing it. It raises a fundamental question about the buyers themselves. Why does a physical object become more attractive the moment it is placed out of reach? To understand this, we have to look past the retail boutiques and examine the wiring of the human mind. For decades, a mechanical watch had a simple job: keep time. When cheap, battery-powered quartz watches arrived in the 1970s, they were far more accurate than even the most expensive Swiss mechanical models. The traditional watch should have died out. Instead, it survived by changing its entire meaning. It transformed from a practical tool into a piece of art, and eventually into an alternative financial asset. This evolution split the market into two very different groups: collectors and investors. The traditional collector is driven by emotion. They study the history of independent watchmakers, the sweep of the second hand, and the balance of the dial. They buy because of a personal, emotional connection, often planning to pass the watch down to the next generation. But a new type of buyer has taken over. The modern investor looks at a watch dial and sees a stock ticker. They prioritize upside, liquidity, and price support. Wealth surveys show that roughly 34% of high net worth individuals now view these treasure assets as active investment vehicles rather than simple collectibles. They are not looking for a timekeeper. They are looking for a stable place to store their capital. For these buyers, extreme scarcity is the main attraction. In the world of the ultra-wealthy, a high net worth is no longer enough to stand out. When any millionaire can buy a luxury SUV, an ultra-rare watch becomes a shortcut to social rank. It acts as an instant signal of access and exclusive status, proving you belong to a very small, highly privileged group. This status logic is what makes the scarcity system highly believable to buyers. If everyone could easily buy a watch, its power as a social signal would vanish. But because it is nearly impossible to get, the high price tag is justified. It allows the buyer to show off their rank today, while believing the asset will protect their wealth tomorrow. Yet, treating a physical, mechanical object like a stock comes with its own particular challenges. Unlike a digital share, a watch requires physical maintenance, which raises an important question. What does the real return on these ultra-rare timepieces actually look like once you factor in the real-world costs of keeping them? The numbers on the price tag are only the beginning. Keeping a mechanical watch running requires regular servicing every 3 to 5 years, costing $500 to over $1,000 each time. If a rare movement needs custom parts, that single bill can easily top $1,500. Then comes protection. Standard insurance runs between $100 and $500 a year. That cost climbs quickly for pieces worth over $100,000, which also require paid professional appraisals. To keep these assets safe, serious collectors pay for secure, climate-controlled vault storage. This typically eats up another 1 to 2% of the watch's total value every single year. For a $250,000 watch, that is up to $5,000 annually, just to keep it in a dark box. Buying the watch is the easy part. Selling it is where the real math begins. The secondary market is highly specialized, and the gatekeepers demand their share. When you finally decide to sell, auction houses and dealers take a 10 to 15% commission. Trading platforms like Bob's Watches use a tight bid-ask spread, just like a stock exchange, showing you exactly how much money is lost in the middle. There is also the heavy price of bad housekeeping. If you lose the original factory box, the warranty papers, or the service history, the market punishes you instantly. Missing paperwork can slash a watch's resale value by 15 to 30%. Collectors demand a perfect paper trail because the alternative is terrifying. An estimated 40 million counterfeit watches are produced every single year. Some are cheap fakes, but others are sophisticated Franken-watches built with altered dials and swapped parts that only an expert can spot. Because selling is so expensive and slow, some ultra-wealthy owners do not sell at all. Instead, they use their collections as collateral, taking out specialized, luxury watch-backed loans to get quick cash without losing the asset. When you add up the servicing, the insurance, the vault fees, and the transaction commissions, the actual net return on these pieces often drops to a modest 4 to 6% a year. That is close to a low-risk bond, but with none of the liquidity. Remember that anonymous bright blue watch from earlier? In May 2022, a steel Rolex Oyster Perpetual with a turquoise dial walked onto the auction block at Christie's. It was a simple 3-hand watch, lacking any complex gears or precious metals. Yet when the hammer fell, the final price tag read $70,000. At retail, that same watch originally cost roughly $16,500 to $18,000. Why would someone pay a premium of over $50,000 for a basic steel model? The answer has nothing to do with the physical hardware inside the case. The movement inside this watch is the exact same mechanism found in models with plain black or silver dials, which sell for a fraction of that price. There was no new mechanical breakthrough. Instead, the massive jump in value happened entirely because of a symbol. The watch world quickly nicknamed this shade Tiffany Blue. Even though the watch was not an official collaboration with the famous jeweler, the color alone created an instant association with elite luxury. The market began treating the dial as a cultural trophy. This is how a familiar product becomes a headline-grabbing hype asset. Today, the price for a turquoise Oyster Perpetual fluctuates constantly, heavily influenced by the case size and retail tier. A 36mm version might sit at one price point, while a smaller 31mm model commands another. The final number a buyer pays on the secondary market depends almost entirely on the condition of the watch and whether it comes as a complete set, meaning it still has its original box and warranty papers. For the ultra-wealthy, buying this watch is not about appreciating the art of Swiss watchmaking. It is about wearing an unmistakable sign of access. The bright blue dial acts as a billboard on the wrist, signaling to everyone in the room that the wearer bypassed the gatekeepers and secured one of the most talked-about colors in the world. It proves that in the modern luxury market, a clever story and a symbolic association can matter far more than the hardware itself. The FP Journet Chronometer Bleu entered the market in 2009 with an official retail price of $26,000. Unlike massive corporate brands, this boutique Swiss workshop operates on a microscopic scale. FP Journet produces only 900 to 1,000 watches per year across their entire brand. Let that sink in. That is the global output for an entire year. For the Chronometer Bleu itself, the company capped production at roughly 190 units annually through 2019. After that, they cut the annual number even further, making new examples incredibly difficult to find. While giant watch conglomerates answer to corporate shareholders demanding constant sales growth, independent makers like Journet focus entirely on high horology. This shifts the motivation from volume to artistic integrity, ensuring that each signature blue dial receives careful attention. In a market often fueled by speculative spikes, this extreme scarcity should create a wild price explosion. Yet, the secondary market for this watch behaves with remarkable discipline. Instead of skyrocketing to 4 times its retail value, the Chronometer Bleu often trades very close to its original retail price. Many pre-owned examples lose only about 10% of their value, while others show quiet, steady preservation over decades. A collector who bought this watch in 2009 and sold it in 2026 would see an average return of less than 1% per year. This stability is not a failure of demand. It is a calculated strategy built on trust. FP Journet acts as a quiet cult maker whose reputation among informed collectors changes how low production behaves. The brand does not use aggressive marketing or artificial waitlists to whip up retail panic. They simply maintain a strict, unyielding limit on what their watchmakers can physically build in their independent Swiss workshop. Because buyers know the production numbers are real and constant, they do not treat the timepiece like a volatile stock. The value of the watch rests on the reputation of the workshop, rather than a passing trend. This level of capital preservation makes the brand an attractive alternative to traditional investments, even if it lacks the massive short-term spikes of speculative assets. In a volatile financial climate, collectors view the watch as a secure store of value, knowing the company will never flood the market to cash in on temporary hype. It proves that rarity does not always create frenzy. Instead, it offers a different path, showing that a watch can hold its value because the market trusts its long-term discipline. In early 2021, Patek Philippe did something that sent a shockwave through the luxury world. They announced the end of the steel Nautilus, reference 5711. This single model had been in production for roughly 43 years. It was the absolute crown jewel of the brand, yet they chose to kill it off. The reaction was immediate and extreme. Within a single week of the announcement, secondary market prices for the 5711 surged by 50%. Average list prices jumped overnight from €60,000 to €90,000. Buyers who had spent years waiting for a call suddenly realized that call was never coming. By 2024, the price of a standard pre-owned steel Nautilus had climbed to around $140,000. This was not a slow, steady rise. It was a massive price jump driven by pure panic. When a watchmaker permanently stops making a model, they freeze the supply forever. The normal rules of shopping break down, replaced by a deep fear of missing out on a finite piece of history. This frenzy reached its absolute peak with a highly exclusive variant. Patek Philippe created a final run of just 170 Nautilus watches featuring a bright Tiffany blue dial. The retail price was $52,000, but only the most connected VIPs in the world had the chance to buy one. When one of these rare pieces went to a charity auction, the final bid reached $6.5 million. This eye-watering figure proves a fundamental truth about the ultra-rare market. The price of these watches is not tied to the cost of raw materials or the time spent building them. It is tied to emotion. When a legendary manufacturer closes the production line for good, they compress decades of steady growth into a single moment of high-stakes theater. The value of the watch stops being about what it can do and becomes entirely about the fact that no more will ever exist. In early 2023, Chrono24, one of the largest online watch platforms, cut 13% of its workforce. This change did not happen because of a random corporate restructure. It was a direct response to a quiet, steady drop in pre-owned watch prices. A loud market can look incredibly strong right before its momentum weakens. For years, the secondary market felt like a sure bet, with prices climbing week after week. But the secondary market is fragile. When a market begins to cool, the slowdown does not hit the big brands or official boutiques first. It hits the resellers, the online platforms, and the independent dealers who hold the inventory. This creates a major problem for a specific type of buyer: the flipper. These are the speculators who buy watches with the sole intention of selling them quickly for a profit. They do not care about the history of the watch or the craftsmanship. They only care about a fast exit and a quick payday. But when resale momentum slows down, those quick exits disappear. A watch is not a digital stock. You cannot sell it with the click of a button. It is a physical object that requires a willing buyer on the other side. If that buyer decides to wait, the asset becomes highly illiquid. Let us pause and look at the reality. If you buy a stock and it drops, you have a loss on a screen. If you buy a $30,000 watch with borrowed money hoping to flip it, and the buyers vanish, you are left with a real debt and a metal box you cannot eat. This is where a normal market correction turns into a sharper loss of confidence. A healthy market expects small price drops, but in a hype-driven market, people buy simply because they think someone else will pay more tomorrow. The speculation only works while someone else still wants in. When that belief breaks, the demand evaporates. The ultimate damage of this cooling demand is not shared equally. The famous watchmakers will survive because their history keeps them strong. The people who get hurt first are the speculators who treated these objects like lottery tickets, only to find themselves holding a product that has suddenly moved from a must-have to a maybe later. If this market is shifting, 3 potential paths lie ahead. The first path is a slow, steady decline. In this scenario, the wild price spikes fade away, and secondary market premiums slowly drift down toward retail. Flipping a watch for a quick fortune becomes a thing of the past. The second path is a sharp, sudden correction. This is the danger zone for late buyers who bought near the absolute peak. If prices drop fast, these buyers face immediate losses on paper, holding assets they cannot easily sell without taking a massive hit. The third path is a long-term cool-down. Here, the entire idea of watches as easy alternative assets loses its shine. People realize that keeping a watch is not like holding a digital stock. In a flat or falling market, the real math of ownership becomes brutal. Carrying costs do not stop just because prices freeze. You still have to pay $500 to $1,000 for regular maintenance. Safe storage still takes 1 to 2% of the watch's value every year, and insurance costs hundreds more. On top of that, new US tariffs of up to 39% on Swiss imports push retail prices higher, making it even harder for new buyers to enter the market. If you decide to cut your losses and sell, dealers and auction platforms will take a 10 to 15% bite out of your final payout. This is where the line between speculators and collectors becomes a wall. If you bought a timepiece purely to make a profit, these fees and frozen prices are a quiet disaster. You are bleeding cash every month just to keep a mechanical object in a metal safe. But if you bought the watch because you love the design, the history, or the engineering, a market drop does not hurt. You can simply put the watch on your wrist, walk out the door, and enjoy it. This division exposes the core tension of the modern watch world. It forces us to look past the spreadsheets, the auction records, and the hype cycles and ask what these small machines are actually worth to us. Are they financial tools to hedge against inflation, or are they cultural objects that tell a story about who we are? Today, these tiny mechanical machines no longer just tell time. They tell us who has access to the ultimate elite club. As passion turns into speculation, the real danger is not a falling market. It is that we have turned craftsmanship into nothing more than a volatile stock ticker. When the music stops, who will be left holding the watch? Share your thoughts below.